So in this video, we're going to be discussing one main ASX ETF from all the main ETF providers in Australia. Because when Aussies want to invest in the Australian market, these ETFs are by far their favorite choices and their top picks. So today I'm going to compare all these ETFs in terms of their fees, their returns, and some other metrics as well. And I'm going to tell you guys how I buy these ETFs and which ETFs I buy personally. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we begin, this video is not financial advice. I'm not a financial advisor. We're speaking in a very general sense only. Please do some research on your own as well, because I'm just a normal investor just like you. So let's have a look at a quick overview of each ETF. Starting off with the first ETF, we have VAS. This is VAS, which is Vanguard Australian Shares. This is by far the most popular choice for Australian investors when they want to get exposure to Australia. So let's have a look at some quick metrics of this ETF. So quick facts of this ETF are: the fund size is $8 billion. It's domiciled in Australia because, of course, it's tracking the Australian market. The fund inception was May 2009, so it's been running for about 12 years or so, which is quite good to see. And the management fee is 0.1%, which means that over the course of a year, if you invest $10,000 in this ETF, you're going to be paying around $10 per year in fees, which is of course very minimal. Now, the main differentiating factor of this ETF is the fact that it is tracking the ASX 300 index, not the ASX 200 index. So the differentiation is that the ASX 300 index is basically ASX 200 plus an additional small to mid cap companies which this ETF is tracking. And this ETF basically covers around 90% of the overall Aussie share market. So when you invest in this ETF, you're getting a pretty good projection of how the Australian economy is made up. And the sectors that it's tracking is mostly skewed towards financials, which is 29%, materials is 20%, then you have healthcare at 10%. And you'll find that with all the ETFs that we're going to look at, this is a similar sort of weighting that you're going to see, because of course all ETFs in this video are tracking the Aussie market. And correspondingly, when you look at the actual companies that make up this ETF, we can see that the first one is CBA, then you have BHP, CSL, and the top 10 companies basically revolve around materials and financials mostly. Now, by the way, if you guys are interested in specifically Vanguard, I've done a whole separate video on that already where I compare the 5 of the best Vanguard ETFs for Australians. There should be a link somewhere here as well, so go check it out, and there's a link in description as well. The second ETF that we have is ASX A200 by BetaShares, and this is probably the second most popular ETF on this list. This is the BetaShares Australia 200 ETF, and basically when you buy this ETF, you're buying the ASX 200 index essentially. The fees for this ETF are pretty minimal at 0.07% per year, which is $7 per 10k invested. So it's a bit less than the first ETF that we had a look at, but it's very minimal. It currently pays a quarterly dividend, and we can see that in terms of the actual holdings, it is pretty similar to VAS, because we can see that the first one is CBA, then you have BHP, CSL, a couple more banks, and some other companies as well when it comes to materials and consumer. So it's going to be pretty similar trend that we're going to see with this next couple of ETFs. The only difference you'll find when it comes to this sort of stuff is the fact that CBA has a higher weighting at 8.9%, whereas with the previous ETF, CBA had a weighting of about 7.5%. So it's a very minimal difference, and you can probably assume why that's the case, because since the ASX 200 has lesser companies than the first one, the companies by default are going to have a slightly higher weighting. And the sector allocation looks pretty similar as well. Now guys, once again, if you are looking for the best BetaShares ETFs right now, I've done a whole separate video on that as well. There should be a link in description, and there should be a link somewhere here as well, so go check it out. The next ETF is IOZ by BlackRock. This is the iShares Core S&P 500 ASX 200 ETF, and of course, as the name suggests, this is basically as same as the one before because it's tracking the same index. The management fees are slightly higher at 0.09%, but it's a very minimal difference. The ETF has been running since 2010, and currently it pays a quarterly dividend. Now, of course, this is pretty similar, so we're not going to go too much into it. Let's move on to the next ETF. Now, the fourth ETF on this list is ASX MVW. This is the Van Eck Vectors Australian Equal Weight ETF. Now, this ETF though, we are going to go a bit more in depth into, because I think it's pretty important if you are looking to invest in the Aussie market. So the management fees for MVW are 0.35% per year, and they pay a semi-annual dividend. But to be honest, the fees for this one are a bit higher. They're actually the highest on this list, but based on the returns that you're potentially going to be getting and the upside that's there when it comes to technology, I think it's worth it to pay the fees, and we'll have a look at the past returns as well in just a second. So to put it in a nutshell, this ETF basically tracks the largest listed companies companies on the ASX, but this ETF gives each company an equal weight of roughly 1%. And we'll have a look at this in just a second because, as you guys know, the Australian share market is largely skewed towards financials and materials because we have the big banks and the big mining companies, and those two sectors basically make up around 50% of our Australian economy. So this ETF tries to smooth all of that out by giving each company a 1% weighting. And super large companies like CBA, Rio, and BHP, all these companies basically have a 3% combined weighting in this ETF, whereas if you looked at these three companies on a normal ETF like the one that we just had a look at, those weightings are obviously really higher. So you can say that this ETF tries to be more balanced when it comes to your investment strategy, and as we know, tech sector is quite underrepresented when it comes to Australia, and there is very little allocation towards technology because most of our allocations is based in materials and financials. So this basically gives the tech sector a bit of a boost, a small boost, but it's still a bit of a boost. So essentially with this ETF, you are getting a higher upside when it comes to the tech side of things, and we'll have a look at the returns more closely when we're going to compare the returns for each of these ETFs. And you'll see that this ETF has actually performed quite well. So you can see that the three main sectors are materials, financials, and industrials. But if you have a look at the IT, this has jumped up to 7% where before it was not as high. And this pie chart starts to look a bit more even. If you compare this to the ASX 200 ETF, we can see that it's very skewed towards materials and financials. And if we have a look at the holdings for this ETF, we can see that the highest weighting is 1.25%, and this is to Evolution Mining, and CBA and all the big companies are not even in the top 10 of this list. So when it comes to the weightings, you don't need to worry too much about that because each one is going to be weighted roughly around that 1% mark anyways. Now, a fun fact about this ETF, you can actually buy this ETF completely brokerage free using a new brokerage platform called Perla, and this broker is specifically designed for long-term investors like myself and you as well if you're watching this video. So Perla allows you to buy this ETF completely brokerage free if you hold it for more than a year, and you only pay brokerage once you sell, and the brokerage is going to be $9.50 for trades under 17.5k. So when it comes to brokerage, effectively you are paying less than $5 per trade, which is very competitive for a CHESS sponsored broker. And if you're watching this video, chances are you are a long-term investor as well, so it's totally worth it. And if you use my code Fyzee, which is just my first name, you will also get a free investment credit, which translates to $10 of free brokerage to get yourself started. So go check it out. There should be a link in description as well. So guys, that was MVW. I wanted to spend a bit more time on this one because I think it's very important to have a look at because the other ETFs on this list are fairly similar. Now, last but probably the least, I'm kidding, we have ASX STW. This is the SPDR S&P ASX 200 fund. Now, this was actually the first ETF in Australia, and when it comes to the fees, it is 0.13% per year, which is the highest when it comes to the normal ASX 200 ETFs on this list. And if we look at the asset allocation and the holdings for this ETF, they are pretty similar to the other ones that we had a look at, so we're not going to go too much into this just now. Now we're going to compare every single ETF on this list in a table, and we're going to compare all the fees and all the returns in just a second. But before we do, guys, if you have found value in this video so far, please leave a like or subscribe. It really does help out with the YouTube algorithm. Let's get into it. So in this table, I've arranged every single ETF by the order of appearance in this video. So at first we've got the Vanguard, then we have Beta Shares, IOZ, VanEck, and then the State Street ETF, and we can see the relevant ticker codes in the first row. And then we have the index that this ETF is tracking. Now you guys can probably see that the ETF indexes are different for each one of them, even though the ETF is tracking the same thing. Now I wouldn't really worry about this too much because at the end of the day, it is tracking the index, which is ASX 200. It's just that each index has a different methodology, so let's not go too much into that. It is basically the same thing. Now the management fees is where the real difference comes in, because we can see that for the first three ETFs, you are getting fees of 0.1% or below, but then comes MVW at 0.35%, which may seem like a huge increase when it comes to fees, but as we'll have a look at with the returns, this may be worth paying for. And then lastly, we have ASX STW at 0.13% of fees. So when it comes to just judging these ETFs by the fees, we can probably ignore the IOZ ETF and the STW ETF because the fees are 0.09 and 0.13. So there's no real point when it comes to buying these ETFs, because if you can can just buy the A200 ETF and pay 0.07%, why would you not just pay that, right? Because at the end of the day, these three ETFs are tracking the exact same thing, and if you can choose an ETF that has a lower fee, it's kind of a no-brainer to select that option. The dividend frequency is 4 per year, so that's completely fine, except for the MVW ETF. Now, I suppose this shouldn't really matter because in Australia, we normally get dividends twice per year anyways, and if you're getting dividends 4 times a year, that's just a bonus, so I think that should be fine. Having a look at the inception date, the A200 ETF seems to be the most recent ETF launched, but most other ETFs have been running for quite some time. The 1-year return does seem to be pretty similar for the first 3 and the last ETF, but the 4th one is lacking at 22.5%. But when it comes to this sort of stuff, it is best to track the ETFs on a longer time frame, like say 5 years. So if you look at the 5-year time frame, we can see that the MVW ETF seems to be the highest at 32%, which is pretty solid. The ASX 200 ETFs, which are IOZ and STW, these seems to be underperforming when it comes to the ASX 300 index, if you guys can have a look. Now, of course, I haven't included the A200 ETF because it's only just launched. It's been like 3 years, so we don't have the 5-year data for it. And looking at the total companies, we can see that MVW tracks only 100 companies, but the other ones are 200 and 300 roughly. So I hope that looking at that table was helpful for you guys when it comes to understanding each of the metrics and the stats for each ETF. Now we're going to have a look at a graph view for the returns for each ETF. So let's have a look. So here we have every single ETF mentioned on this list, and I know that this graph looks pretty messy, but we're going to dissect this in just a second. So starting off, we can see that looking at a 5-year time frame, the first ETF that has outperformed every single other ETF is in fact the MVW ETF, which is shown by the orange, as you guys can see. Currently, it is the highest. It was the highest performing ETF before the crash that we saw in March, but afterwards, it has been going up more than its peers. However, if we look at the max return for this graph, we can see that actually the STW ETF has been outperforming every single ETF on this list, and the reason being is because this ETF was literally the first one to be launched, so it's had a lot more time to run, and it is going to outperform every single other ETF out there because for the sole fact that it's had a long time to get all that growth. Because just remember, this graph is tracking percentage returns only, so the index has gone up quite a lot since it first launched. The 1-year return, however, seems to be pretty similar for the other 4 ETFs out there. The only outlier is the MVW ETF because it hasn't performed too well when it comes to just this recent 1-year time frame. But if we zoom out and look at the 5-year time frame, as we had a look before, it has been doing pretty well. So I do think MVW is worth considering. So that extra 0.35% towards MVW may be worth it depending on how you look at it. If you think that the technology sector in the ASX is going to do pretty well, it may be worth looking into, but of course it's all up to you guys. Now guys, when it comes to what I've been buying to get exposure to the Aussie market, I've been buying into A200 and recently MVW as well. And the reason for buying into A200 was because IOZ and STW do charge higher fees. Even though they are very minuscule and they're very tiny bit more, it's still worth it to pay the less fee if you've got the option to do so. And at the end of the day, these ETFs are tracking the exact same index. They just have different methodologies and they have different names. Plus A200 is by BetaShares, which is of course an Aussie company, and STW is by State Street, and IOZ is by BlackRock, which are both American companies. So if you are going to pay the fees anyways, it is better to support Australian companies and just pay the fee to an Aussie company to help Australia. Now quick note, I think that the parent organization for BetaShares is not Australian. I think it's some other country, but look, nonetheless, it is still very helpful. Now I do know that I can buy into VAS as well, which tracks the ASX 300 index, which is much more broader, but it is my belief that I think that ASX 200 is going to outperform the ASX 300, but at the end of the day, it doesn't really matter. Either ETF that you buy into, you are getting quite a huge exposure. So if you were to compare the ASX 300 or the A200 ETF, it really just depends on what your view of the Aussie market is. If you think that the ASX 300 is going to perform better, then you can buy into VAS. If you think the ASX 200 is going to perform better, you can buy into A200. It's really up to you. And lastly, I bought into MVW because it has a better allocation towards technology, and I do think think that, of course, tech is very underrepresented in Australia. So as technology grows and as our technology sector starts to improve and get better, I will catch some of that upside as well, hopefully. And when it comes to buying MVW, I'm going to be buying it using Perla because it's basically a no-brainer. You're getting free brokerage to buy an ETF if you hold it for more than a year. And since I'm a long-term investor, I'm gonna hold it for obviously for more than a year anyways. I don't plan on selling anytime soon unless there's like an emergency. Hopefully not, but yeah. Now guys, just in case you want an in-depth video into the best ETFs from Vanguard, BetaShares, iShares and all these other companies, there should be a playlist right here, and this video is my top 4 Asian ETFs for Australian investors if you want to get exposure to Asia. So check this video out, and guys, thanks for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Now I do know that I can